So again, thanks for jumping on. There's a chat box on the bottom of your screen. You can go ahead and type in any questions you might have as we get going through here. As some of you have already started doing, so thank you. So I'll answer those questions as we move along, and at the end we'll open it up to questions as well. So without further ado, here we go. DLP Capital Partners, maybe if you haven't paid attention to us a little bit in a little while, you might have noticed that we used to be called DLP Capital Advisors. We've rebranded ourselves as DLP Capital Partners here in the last few months, which we're really excited about, that we think better exemplifies who we are, what we do, and the fact that we really focus on partnering. We're not really here advising you on a wide range of different investment opportunities. We're really focused on providing you opportunity to invest in the funds that we manage here at DLP that we think are some of the best certainly in the industry, if not out of all asset classes. A little bit about myself. A couple of the names on here, a few of the names I'm not familiar with, so it might be a first time we're getting to know each other here. So I'll give a quick overview. And if you've been following us for a while, you'll notice some of these numbers changing that you see on the screen here. So I've been in real estate now for about 12 years. I founded DLP about 11 years ago and serve as the CEO and primary owner across our family of companies. 12 years now in real estate. We now own, with our investors, over 6,000 apartments and houses. I've also closed over 6,000 real estate transactions. I think it's actually just under 7,000 now for over $1 billion. Ranked as one of the top 10 real estate professionals in the U.S. And again, CEO of our family of companies. And you'll see my two little boys. Looks like we need to put an updated picture there. But my two little boys who are 4 and 6 now, about to be 5 and 6. And my wife there at the bottom here in our neighborhood in St. Augustine, Florida, which is where I'm talking with you from tonight or this evening. After this webinar, if this grabs your attention, you want to learn more about us and how the fund works. If you haven't already done so, you can go to dlpcrowd.com. You can see all the details, presentations, documents, quarterly reports, audits on all of our funds, including this equity fund too. And then our current investors also are able to have access to their account statements, distribution history, all their signed documents. It's a full investor portal. It'll give you access to anything and everything you want to know about us and about your investments. These are where our properties and our loans are located. The other side of our business is we make loans to real estate investors. So where some of our other funds focus on. So on the left, you'll see our properties and our loans, and it's a little hard to read probably depending on your computer screen size. In the middle is where our properties are located, and on our right are where our loans are located. So you're gonna, if anybody again you've been with us a little while, you're gonna be noticing throughout the Southeast that map is starting to fill out quite a bit more. And it'll certainly continue to do so as over the next year here as we continue to acquire properties. Here's where our offices are actually located. I'm talking to you from that St. Augustine, Florida office there on the bottom, the 564 Market Street, although we have another office down at the beach. And soon we're closing on a new Southeast headquarters office about 100 feet from where I'm at right now, which I'm really excited about. You'll see probably the next time I do one of these. We're headquartered still in Bethlehem, Pennsylvania. It's where we have over 100 of our amazing team members work there, including our CFO, COO, and a lot of our leadership team across our companies. And we have a few other offices throughout PA, Florida, and New Jersey. This is our executive team. So Jason Battistelli, who was our head of property management, is now our COO across all of our companies. Bob and Barry are also, in addition to being general counsel and CFO, are also partners here at DLP Capital Partners. And then you'll also notice a new face on the right-hand side of your screen, Harlan Critchman. Harlan is now our president of DLP Property Management, our first ever president outside of myself. He was president previously of the 4th largest property management company in the U.S. Brings amazing talent to our team. So a lot of great leaders, many of which have been with us for many years. Rest of our leadership team here throughout, won't spend a lot of time because a lot of faces. It gives you a little feel for the faces that across our family of companies, many of them within property management to serve these properties that we're going to be talking about here in a minute. But all total, we have 40 people as part of our leadership team out of our 260 or so employees. This is all of our family of companies here that work together to execute on our investment strategies. And how we got started to all those pretty faces I just showed you and the big numbers I just told you, number of units we own and number of employees, is started in real estate 12 years ago, started flipping houses about 11 years ago. About 8 years ago, we started building a rental portfolio. So until that point, we had mainly been flipping and selling properties. As you might remember, the market was crashing. That was 2008, 2009, 2010. And then around 2011-ish, when the market really started improving, we really started building our rental portfolio. And then about 5 years ago, we really shifted our focus as an operator from single family to multifamily. Although we still own hundreds of single family homes, we really started focusing on multifamily, which is the strategy of this equity fund too. In addition, we also focus on lending money to real estate investors, which is what our other funds, the lending fund does, and the income and growth fund actually operates within both strategies. So a little bit of our track record, we've hit our fixed and our preferred returns to our investors every single month for now, close to 10 years in all of our funds. Every single month we've hit not only the fixed return, but the preferred returns, which are not fixed returns, but we've never missed that target, which is the return you earn before we earn anything. We've achieved double-digit returns for all of our equity investors per year, every year. We have zero principal losses. We currently have six investment funds, over 350 investors, over 500 million now in assets. And that's 400 properties, 6,000 units, and over 300 loans. So again, if you were just on a webinar a month ago, you'll notice these numbers have changed as we just broke $500 million and just broke 6,000 units, as well as just broke 300 loan mark. All, of course, are the highest and largest we've been as we continue our 20-mile march forward in our growth. 250 plus employees now across 8 states. We're one of the 5,000 fastest growing companies for the last 5 years. We do over 100 million in annual revenue. And what we're focused on is investing in 100 to 500 unit apartment communities, which is what the Equity Fund 2 does. Here's our purpose: living our dream to create prosperity through innovative real estate solutions. These are the values that drive us, drive who we hire, drive the people we hire, and really drive our results. All right, so with all that said about DLP, let's talk about the fund and the investment and what we buy and what we do. So first, I'll give you the high level here of how you benefit as an investor in the Equity Fund 2 from a financial standpoint, why you should be interested in investing into the Equity Fund 2. So the duration of the fund, what we do in the fund is we buy multifamily communities. Plain and simple, it says we could also buy some commercial properties and single-family homes. We have not, and we are not going to. All the assets will be multifamily communities. The fund could be up to 10 years, so basically up to 9 years from now, as the fund is about a year. Actually, I think we opened the fund this week last year, so it's right about a year mark. The fund's been open. You'll be surprised to hear it's been open just 1 year for all the properties we acquired, as I'm going to show you. So the fund could be open for up to another 9 years, likely be 6 to 8 years from now. We distribute out quarterly. We may eventually go to monthly, but right now we distribute out on a quarterly basis. The goal is to generate a 7 to 8% annual return paid out quarterly now during the investment period. We've been exceeding that already in our first year. The goal at the end of the fund is to distribute out 2 times your original investment, bringing your overall return to 17% annual return net to you. So the preferred return is 7%. That's what you earn before we earn anything. Again, overall return goal of 17% net annual return. That means net to you after we earn our share of the profits and earn our management fee. After we generate your 7% preferred return, we get 20% of the profits. You get 80% of the profits, with a target of 17% net to you. Even though this is a fund that could be up to 10 years in length, you can redeem your investment out with 180 days notice. You would not go into this fund, though, unless you were looking for longer term investment. But if life happens, good or bad, you can get out sooner. You can get out with 180 days or less notice. We do leverage through bank financing. You can invest through your IRA. You can invest through your brokerage account. There are significant tax shelters through this fund, through depreciation, which we'll talk more about. All right, so again, these are some of the custodians that we work with that you can invest right through your Schwab account, Fidelity account, etc. What we do with this fund is we're buying multifamily communities, 100 to 500 unit B and C class properties, which I'll explain more, and predominantly value add properties, properties that are not performing as well as they could be due to a wide variety of reasons that I'll show you. How we go about mitigating risk and buying real estate is really, really important because anybody can talk about big returns. Anybody can talk about operating properties at a really high level, increasing rents. But the key is, are you actually able to execute and do it? So for us, one of our biggest ways we mitigate risk is through our strong in-house management. Currently, DLP Property Management manages 100% of the properties that we own. Our in-house management team consists of Harlan, our president, who I just mentioned, who ran the fourth largest property management company in the entire country for 7 years, a vice president of marketing and leasing, a senior vice president of operations, 4 regional property managers, senior asset managers. Our COO ran our property management company before and oversees the whole team, and then about 30 property managers and a whole team of over 100 people. That's a really critical part of what we're able to do. I'd much rather hire third-party managers. It'd be a lot easier to not do the management. Doing residential property management is not a exciting, and Harlan might have a different opinion, but it's not an exciting and sexy business per se. It's a lot of work, a lot of effort, a lot of people involved. But without it, we would not be able to generate these kind of returns. We would not be able to execute the way we do because it's all about your ability to execute, and that's what we do at DLP Property Management. The next way that we really focus on mitigating risk, and I'm starting off the talk on the specific fund on mitigating risk because I think it's what's most important. Our number one principle at DLP, investment principle, is no losses to investors ever. So it's about how you mitigate risk. And we all know the real estate market goes up and it goes down. The key is how do you mitigate that risk? So first is execution through our management company. Second is discipline, and more specifically, discipline buying. So in today's market, properties are typically selling in the low 5s cap rate or low 6 cap rates. If you're not familiar with what I'm talking about, that means if you bought a property for $1 million, a 5 cap rate would mean if you bought it all cash, you would get a $50,000 net return, 5%, which is what a cap rate is. 5 is the return you would get from rental income if you bought a property all cash. So most investors right now are buying deals in the low 5s to low 6s for these types of properties we buy. Typically, people, in order to buy a property, they have to outbid everybody else. They have to essentially overpay in order to buy a deal. We don't believe overpaying is winning. We don't believe that's the way you make money. We believe, it's easy to say, but we believe wholeheartedly that you make money on the buy. You make money by buying something that's worth more than what you're paying. That's really what we focus on doing, and you'll see more how we go about that process in a second. The next way we mitigate risk is through long-term non-recourse debt. Interest rates are going up. That's a reality that will continue, in my opinion. So it's often people say, well, how are these interest rates going to affect you? Of course, interest rates affect everybody in real estate. In most cases, though, it actually benefits us. And one of the main reasons for that is we're not typically exposed to increase in rates on our portfolio properties because when we buy a property, we're typically locking into a 7 to 12-year fixed term, meaning the rate can't change during that term, and usually a 30-year total term, but the rate's locked in for 7 to 12 years. So as rates go up, in some ways our assets actually are increasing value because we typically have assumable non-recourse debt with locked-in rates lower than where the current rates are. In addition to our locking in longer-term loans, so we can't face higher rates. Again, as I just mentioned, our loans are non-recourse, meaning lenders can't come after us. In addition, we, on average, across our portfolio, our leverage is only 55%. So we're not highly leveraged like a lot of real estate operators are. We keep a lot of equity in our properties, which allows us to get the benefits of leverage, both in terms of higher returns because of the low rates, as well as significantly more tax benefits through more depreciation, which is really critical in this strategy. Here's how we look at buying properties. So we're focusing on B and C class properties, mainly 100 to 500 units. We are buying mainly right now in Florida, Georgia, North Carolina, South Carolina, Mississippi, Alabama, but we will look at other states as well. We're focused more on the criteria within that market. Really, the supply and demand in that market is the big driver. We focus on buying properties that by the second year we own the property, we have over an 8.5% cap rate. So again, the market right now is 5 to 6% cap rates. We need to be over 8.5. Usually we're over 9, which means we're buying properties where our costs are 50% less than the current value or the value of the property operating at its pro forma, which is usually the second year we own the property. So that means we're in a very good position that if we owned it all cash, we'd be generating an 8.5, 9% annual return, not factoring in the tax benefits, not factoring in appreciation, just on cash flow from rental income. But then we put in leverage onto the property, 4 or 5% leverage, we end up over 12% cash on cash return just from rental income. 12% return on the equity invested just from cash flow, not factoring in that we're paying down the principal on the mortgage, not factoring in the value we created when we bought the property and improved it, or any value in appreciation. And our overall return, if we own the property, the IRR for 5 to 7 years would have to be over 18% for us to consider a deal. And that's with very conservative underwriting. And we'll buy properties that need heavy lifting. Capital improvement means, the renovations, renovating apartments. We'll buy properties with very little need of renovation. We'd love to buy properties with little need of renovation if we can get the returns. But usually we're putting in a good amount of money into renovations, up to $15,000 or more per unit. Often we're buying properties. We're spending $8,000, $10,000, $12,000 per unit to renovate the properties and maximize our returns. Here's our process to buy those types of deals. To get the kind of deals that I just showed you here, to get deals at 8.5 plus cap rates, it's not an easy task. It's not a task that you can just go out and say, hey, I'm going to go out there, I'm going to buy some deals that get these kind of returns. It doesn't happen. So we look at 300 to 500 deals at least every month. I bet you it's closer to 1,000 deals a month now that we're looking at. These deals come to us from sellers, from brokers, from lenders, from other investors, from banks, from auction houses. So at least 300 to 500 deals every month we're evaluating. We're doing financial analysis. We're digging into the market. We're digging into demographics, evaluating the asset. Then about 40 or 50 deals every month. And I'd say, again, these numbers are probably light from what we're doing now, probably close to 100 deals a month that we do full financial analysis, full deal underwriting, evaluate the rent rolls, the operating system statements, past financials, leases, and do a full rundown, pull full detailed underwriting reports, pull crime reports, really dive deep. Many of those properties we also walk, as you see the next part here, 20 or 30 properties at least a month. And I mean, just in this past week, we've probably walked 15, 16 properties that we've gone out, inspected 10 to 30% or more of the units, walked the competing communities, really got to know the assets, spent many hours, flights, time, effort evaluating deals. And then we put out at least 15 to 20 offers a month. Again, those numbers are probably light now. It's probably more like 30, 40 offers a month at this point where we submit a full offer. And then out of all those offers, we end up getting 2 or 3 accepted every month. So out of those 500 or so deals, 2 to 3 get offered. And then we go into our real due diligence. And that's when we really dive deep. We get through every unit. We get an appraiser out there. We get an environmental inspection done. We get what's called a PCA report done by another third party, a property condition assessment report. We go to the codes office. We do detailed process. We put together full budgets. We get roofers out there. We get mechanics out there. We get engineers out there. We do deep evaluation of the properties. And then about 1 or 2 out of those end up going all the way through due diligence, all the way to closing. And we buy 1 or 2 properties every single month is pretty much our average. Some months are certainly greater than that. That definitely is picking up pace. But on average, we're buying dealing 3 deals every 2 months. Many of the properties we buy need significant renovations: kitchens, bathrooms, ceilings, doors, flooring, paint. This is a picture some of you have seen before, but it's one of my favorites of what community we own in South Carolina. 90 plus units looked just like this, and now most of those units look just like this. Full renovation, hard surface floors, new trim, all new walls, central air, new bathrooms, nice cabinetry, black appliances, really nice 6-panel doors, nice looking lighting, and we've nearly doubled the average rents in this community from the units that were rentable to these units now that we renovated. Um, so why do we do this? So why are we talking about multifamily real estate? Why are we talking about apartments? Why are we investing in this strategy? The first main thing that attracted us to housing in general, more specifically to multifamily, is supply and demand. There is no doubt about it that rentership is on the rise and home ownership is on the decline. My belief, and many economists will agree, that that will continue for as far out into the future as anybody can see. Family formation is happening later in life, which keeps people renting longer. As typical, people buy houses when the families get formed, when they get married, they have kids. People are having kids and getting married later in life. Average age people get married now is 37 years old, which is also the same age the average person is when they buy their first home. So home ownership is starting later in life, and people are not staying with jobs like they used to. We all know that. So we're in a more transient society where people want more flexibility, and rentership provides that much more so than home ownership. In addition, a lot of people say that the quote unquote millennials came to adulthood during the greatest downturn in the real estate market, maybe in history. And so the dream of homeownership isn't what it once was. So rentership is in. And in addition, the fact that there's 30 plus million single family homes that are available for rent, rentership is not looked down upon as grown adults like it once was. It's very common now and likely to continue to be. Um, that's very important. All investments come down to supply and demand, or virtually all. So the supply and demand for multifamily is very, very strong. Then the next question that I would ask if I were you is, well, why do you focus on the markets you focus on, which are mainly the South and the Southeast? And the reason we like those markets is a few reasons, including the three you see on your screen there: strong job growth, which creates strong population growth, and then that creates strong demand. So jobs are growing in Georgia, South Carolina, North Carolina, and the Southeast markets have the best job growth in the country. They have the best population growth in the country outside of Texas, and that creates strong demand for housing. And then the next question is, okay, so housing makes sense. Now I understand why you'd invest in housing. I understand why you do so in the South, but why do you want to buy B and C class apartments? Why not buy brand new apartments? Why not build new apartments? The reason we like B and C class apartments, which if you haven't heard that term before, that means apartments that are not luxury. It's typically apartments built in the 60s, 70s, 80s, 90s that don't have all the amenities of newer properties. Most importantly, what it means is properties with lower rents, affordable rents is the best way, the biggest focus there. So affordable rents. Our average rent on a one bedroom apartment across our portfolio is between $700 to $800 a month, where in those same markets, Class A rents are $1,700, $1,800, $1,900 a month. So we focus on affordable rents. The reason we focus on properties that are affordable, which are B and C class apartments, are these facts here. Since 2010, there's been more than 7 million new housing units, that's single family and multifamily, built in the US. Zero are B and C class. That's not an error, that's zero. So everything being built is Class A. That's all you can afford to build with today's construction costs. So there's a huge growing demand for affordable housing. Again, our average one bedroom rent's under $800 versus the average Class A of $1,800 in those same markets. So by having affordable housing, which is where the jobs are, the jobs coming in Georgia are not jobs that in 80, 90, $100,000 a year typically. They're 30, 40, $50,000 a year jobs. You can't afford $1,800 a month. People are doing it, but you can't actually afford it long term. We believe there's a huge epidemic, and I'm not using that word lightly, for in affordable housing across the U.S. And I think that epidemic is going to continue to grow as income is not growing nearly at the pace that rents are growing. In many markets, rents are going up 8-10% a year, and incomes are not. So we believe, in addition, because of the affordable nature of these types of investments, that we're going to remain in a very strong position through a recession, in that there'll be strong occupancy because people will even more so not be able to afford the Class A rents and will be forced to the B and C class properties. And then lastly, but maybe most importantly, is they produce stronger cash flow because the properties, even though they're trading at still very aggressive cap rates, the cap rates, the pricing investors are willing to pay is much lower than that of Class A. Class A are even higher price, lower cap rates, even lower yields. So with all that said, that focus, B and C class apartments, mainly in the Southeast, is what the Equity Fund 2 does. We now own over $160 million in properties acquired in the past 12 months. That's 2,686 apartments that the fund owns today. The fund closes for investment commitments on March 31st. That means after March 31st, we will not take in any more commitments. Now, you do not need to have the money by March 31st. You have to commit to the fund by March 31st. The fund will then use all the money that gets invested here over the next couple weeks to make investments until we invest all that money. So throughout 2018 might be we utilize all the money in Q2, Q3, Q4. It depends how many of you jump into the fund, how much money comes in here over the next couple weeks. The fund will wind down somewhere between 2023 to 2025. So that's kind of the timetable. And I'm going to walk you through here a little bit about, show you what the fund owns, show you what you'd be investing in this fund. This was the first property we purchased last year. It's in Titusville, Florida. It's a 2-story. This is a pretty traditional garden-style community. It's a block construction property, 2 miles from the beach in the Space Coast. It has a pool. Pretty basic property, 96 apartments. We paid $36,000 a door for this property. We've now renovated about 30 apartments in there, pushed up rents, and it's really starting to perform really, really well, which took us about 8-9 months to really stabilize this property and drive up performance. Great market, huge job growth, huge population growth. Here's an aerial on it. Our second, third, and fourth properties we purchased were all in Warner Robins, Georgia. 3 communities we purchased as one portfolio, 196 units. Our fifth property we purchased was in Conway, South Carolina. Smaller property. It's right outside of Myrtle Beach. Been doing very well for us. This was our sixth property. This was our biggest property the fund purchased at the time, 304 units in Hattiesburg, Mississippi. This is a 1990s built property with good occupancy, pretty well maintained, but a lot of opportunity to push up rents and drive performance. Beautiful outside area with 2 pools, big fireplace, as you can see. All right. The seventh property was in Wilson, North Carolina, 100 units, all single story, Wilson, North Carolina. If you've ever driven down 95, you've probably seen signs for Wilson, North Carolina, right off 95. Augusta, Georgia, we bought 2 properties. This property in Cedar Grove, we purchased this, I believe, in December of last year of 17. This property is both. Oops, let me see if let me see if I can put that person back on mute. Hopefully everybody's back on mute. All right. This property we purchased at the same time, also in Augusta, Georgia. These 2 properties combined are 246 units. Solid properties, C+, B- properties, as you can see from these pictures. Our 10th, 11th, 12th, and 13th properties, with these 4 properties we purchased together in Gulfport, Mississippi, Senatobia, Mississippi, Jackson, Mississippi, and Orange Beach, Alabama. 4 very nice, solid B+ properties, 1,086 total properties we purchased at the very end of 2017. Big opportunity to drive rents, but well-performing properties, off to a great start. As you can see here, they do have fitness centers and pools and clubhouses. But again, average rents are in the 800s. Really excited about this portfolio. Here's where they are on a map if you don't know where some of these towns are. This was our 14th property we bought last month. I'm sorry, actually we purchased this very beginning of this month, I believe. That's not true. It was end of February, last week of February. I'm losing track of time here. End of February, we purchased this property, which is a Cardinal community. We own 9 of these communities, which are single-story, modular built communities built in the 80s predominantly. This is in Spartansburg, South Carolina. This is the second property we bought in that market. Our 15th property we bought the same day. It's in Iris Glen in Conyers, Georgia. It looks very similar. This is also a Cardinal community. And our 16th property we bought yesterday. So this is our second largest community we own. It's called The Views at Long Creek. It's in Columbia, South Carolina. That's a picture of the clubhouse and the pool. It's 419 total units, 23 buildings on 38 acres. Has 3 pools, a tennis court, playgrounds, a fitness center, a dog park. Really, really cool property with enormous opportunity to drive growth and rent there. Distressed management play. So really, really excited about that property. So these are some of all the properties that DLP owns and manages. The equity fund 2 are right here on this slide. So these are all the properties, or at least almost all the properties owned in the equity fund 2. I didn't double check that they're all here, but they should be. So these are the communities owned by the equity fund 2 that you would be investing in. So 2,500, I think it's 2,696, if I remember correctly, total units across 6 states, producing cash flow right here, right now, that you'd be jumping into on day one. All right, so recap the fund again here, and then I'm going to open it up to questions. So you go into this fund, you're going to be committing for the next 7 to 9 years. Could be less, likely be less, but 7 to 9 years. Goal is to distribute to you 7, 8, 9% returns through right now through the investment period, paid out on a quarterly basis. All or nearly all of those distributions will be deferred from tax. Meaning, if you invested $500,000 and in the first 12 months we distribute to you $40,000, which is 8%. Out of that $40,000 we distribute to you, nearly any of it, if any of it, is going to be taxed. Most of it will be deferred from tax through depreciation. Now, what that means is when we wind down the fund at the end, if you took all your returns out, which we expect will have an option that you can continue to defer tax, but if you didn't and you took your money out at the end of the fund, you will now pay taxes, but you'll pay long-term capital gains, and you have had the time value of money. You have earned returns on that money over the next 6, 7, 8 years, and then you'd be paying Uncle Sam at the end at long-term capital gains, which right now are around 16%, less than half of what most of our marginal tax brackets are. And then again, at the end of the fund, the goal is to return back to you 2+ times your original investment, for a total return of over 17% net to you. So with that said, I'm going to open up to questions here. If you're interested in investing in this fund, how it works is you have to make your commitment by March 31st. So that's the next 2 weeks. We can provide you up to June 15th to actually fund your investment. So if you say, hey, look, I got to move things around, I'm selling a property, I'm selling off some investments, whatever the case is, you don't need to actually fund the investment by March 31st. We'll give you up to June 15th to fund the actual investment, but we need the commitments in by the end of the quarter by March 31st. So we can work with you on timing to figure out when you're actually able to fund the investment, but you have to make the commitment by March 31st. So as I said at the beginning here, I am going to unabashedly pitch the fund here. So to go ahead and sign up, you just click on that form there. It'll look like this sheet that what you see right here. And you're just going to put your name, your number, your email address, and the amount you would like to commit to the fund when your funds will be ready. If you're ready to go now, great. The sooner you get in, the sooner you start collecting returns, or what you think for timing. And then myself, Larry, or Bob will reach out to you and coordinate the details. But that's really all we need you to do at this point before March 31st. We'll follow up to do the official paperwork, but we get that done. Then we can have you marked in by March 31st and then work with you over Q2 to fund the actual investment. All right. So with all that said, I think that's the last slide. Oh, almost forgot the dinners. So April 5th is our next dinner here in St. Augustine, Florida at the Palencia Club. Hope you can join us. If you're in Pennsylvania or anywhere outside of Florida and you want to come join us, reach out to us. We'll coordinate a stay for you. Stay at one of our properties in the area. We'll put you up and you can have a good time in some warm weather here. And April 26th is our next big event in Bethlehem, because not only is this an informational dinner, but it's also our big quarterly event where we meet with just our existing investors and go over all the things that happened in the previous quarter. Same thing, if you're not in Pennsylvania and you want to fly up and come meet 100 plus of our existing investors, meet many of our team members, come on up and we'll put you up at a great hotel in Bethlehem and come see historic downtown Bethlehem and come spend some time, see our corporate office, our headquarters, and spend a little time with us. Love to have you do that. Many of our Florida investors have taken us up on that over the past couple years. All right, so with that said, I'm going to open it up to questions. I'm going to take everybody off mute. If you have yourself on mute, I can't take you off mute, so you don't have to worry. But if you're not on mute right now, put yourself on mute if you're not talking, so we don't have kickback behind us. So I'm going to do that now. So everybody should be off mute from my end. And if you prefer, you can just type questions down in the chat box, which we have a few in there right now that I'm going to start us off with. But in the meantime, feel free to just go ahead and call out any questions you have, and I will do my best to provide you full answers on any questions you have. All right, so while people get ready to do that, I'll start off. Don, can you explain the premium now in effect versus the share price last August? Sure. So the unit price when we launched the fund was $1,000 per unit. The price per unit has been, since we did our first closing in Q2 of last year, the unit price has gone up the equivalent of 7.5% per annual. So it's been going up 1.75% per quarter. And the reason we do that is if you invested a year ago today at $1,000 a unit, a year later that would be, I think right now the price would be $1,075 a unit. Might be slightly less, might be one quarter less when we close it. So it might be $1,050 some dollars a unit. I can certainly confirm that for everybody, or Larry H, if you know it offhand and can type it in there for, here or say it, let me know. I don't remember exactly, but regardless, it's 5 or 7% higher than what it was last year. And the reason for that is it's not to penalize anybody coming in later, but it's actually to make it fair for the investors who came in a year ago. Because over the past year, we've increased the value of the properties by likely 7, 8, 9, 10%, as per the goal of distributing out 8, 9% a year, and roughly 8, 9% of the return is through the increase in the value and the pay down of the principal. So we're just trying to keep it fair so that investor came in a year ago is going to end up with about the same return as an investor came in today. Investors come in today aren't getting an unfair advantage and diluting an investor came in a year ago. So just to keep it fair and even to everybody. So yeah, right now it is 7%. So right now it'd be $1,070 per unit, which again a year ago was 1,000, a quarter ago was 1,050. It just keeps it fair because you're stepping into the increase in value. We're not revaluating the portfolio at all. The value of the properties are the same as what we paid for them. So you're coming in at the basis from a year ago or 9 months ago or 6 months ago when we bought the property, and now we've increased the value and the performance, paid down principal on the mortgage, etc. So I hope that answers that question. Feel free, if it didn't, to add more color, and I'll dive into it more. All right, a couple of these questions are private questions, they say, or more specific personal questions, so I will respond to those offline. So thank you. All right, verbal questions. Anybody want to go ahead and ask out any questions? Or type them in as well. Okay, so the question is, how many more properties do we think we're going to buy? So it's going to depend on you. My goal at this point is we have about $1.5 million, $2 million of equity that's been committed already in the last week or so that has not yet been invested. My hope would be we get around another 3 to 4 million over the next 2 weeks that investors commit to the fund, so that we have around $5 or $6 million here to invest after the end of this quarter. So that'll likely turn into another 500 or so apartments. So I'd really like to end up over 3,000 units, around $200 million in total unit or total value. Would be a really, really good number, and actually will have exceeded the goal when we launched this fund a year ago. When we launched this fund a year ago, the goal was to be open for investments for a year to 18 months and to end up around $100 million in properties. So we're going to end up with close to double that size likely in just a year's time of the fund being open, as we've had phenomenal interest in the fund. All right, let me see. All right, so next question. So the 17% return is the question of how do we get to that return. So I know 17% return sounds like a big number. It is a big number, obviously. And I'll just go back to show that kind of that slide. So, and we see this all the time, and I, for any of you, anybody on this call right now, if if you looked at other real estate funds, or you are looking at other real estate funds, or other private funds, or direct deals, investing directly in deals with other real estate investors. What I highly encourage you to evaluate are the assumptions. A guy, and Larry was Hickernell here was in the meeting actually with me when we were talking to a very successful real estate investor who sold his company for very large money in Pittsburgh, and had a successful real estate investing career for 30 years. And the way he summed it up is, garbage in and garbage out. So if your assumptions are garbage, if they're not realistic, everything else doesn't matter. All the returns you say you're going to generate, if the assumptions are off, don't matter. And what we see from a lot of real estate investors is they're optimists, and they say, well, over the last 5 or 6 or 7 or 8 years, rents have been going up 6% or 7% or 8% or 9% a year, which is absolutely true in most markets. And so then they assume that will continue. So that's the first fault we typically see. The second major fault that we typically see is they say, well, right now the market's really hot, and I could sell this property performing well at a 6 cap rate. So they assume when they sell the property in 5 years or 6 years or 7 years or whatever their time horizon is, that it'll still sell at a 6 cap rate. And although that could very likely be true, that's not a conservative assumption. They'll also assume that expenses will not grow as quickly as income will grow or rent will grow, which I don't think, again, probably very likely that could be the case, but not an assumption we're comfortable with. So those are the really big things that we focus on are on those assumptions. So first of all, we assume a 2% annual rent growth, which is conservatively way less than average historically, and certainly considerably less than what's been happening over the last year, 2 years, 5 years, 10 years, and probably much less lower than where they actually will grow. But that makes us feel a lot more comfortable with the assumption. We also assume that expenses will always grow equally as much as income grows. So if income grows 2%, so will expenses. And the third thing we do is we assume that the market's not going to be as good as it is today when it comes time for us to sell. So if we could sell a property for a 6 cap rate today, we assume when it comes time for us to sell the property, we'll be able to sell it for only a 7.5 cap rate, usually 1.5% lower value or higher cap rate, which significantly decreases the sale price. And so we have to use those assumptions plus a lot of other very conservative assumptions and still end up getting to over a 17% return in order to buy the deal. Typically, still we're at a 22, 23, 25% return. So we still have cushion that if we miss something, somehow we still underperform in some way, we'll still end up over 17% net to investors. So that's how we do our assumptions, and we can go through with anybody in more detail and show you that. But I think that's really, really important. And how we get there and is through buying really well, and then secondary creating value through management and capital improvements. All right. No other written question. Anybody have a verbal question? Anybody gonna be the brave soul to start us off and ask a question?
Hey, Don, can you hear me?
I sure can.
Yeah, Don, I just want to ask you, the distributions, can they be invested back into the plan? Would that be considered part of an investment in it?
Yeah, good question. Good question, John. So yes and no. So the short answer is yes. So right now, as long as we are spending money, as long as we're investing money, yes, you can reinvest. So right now you can reinvest. Throughout the rest of this year, you'll certainly be able to reinvest. As long as we're investing into the properties and we have something to do with your money and we can put it to work, yes, you can reinvest. Once we get to the point, let's say we've done all the improvements on the properties and we don't have any other use for more money in the fund, then you will not be able to reinvest anymore. But if or when that would happen, we would be able to give you another alternative option. So to use the example I used earlier, you invested $500,000 and we're distributing out to you 40,000 a year, and you say to me, well, Don, I don't need that 40 grand a year. I want it to reinvest. I want it to compound. Then at worst, we could set up an investment with you in the lending fund or the income and growth fund or our next or another fund we have at that point in time. And we could have your distributions immediately go into another fund so that you're getting the same benefit of compounding returns, but it'll be going into another fund. So we can always give you the option of having your money reinvest and get the power of compounding returns. But it might have to go into another structure once we fully finish investing here in this fund. But that could be 2 years, 3 years, 4 years that we'd be able to keep having the money reinvest.
Okay.
Good question.
Thank you.
Awesome. Thanks for being the brave investor to step up first for the question. Anybody else? Any questions? Tell him, John, it wasn't that hard.
No. Okay, well, Don, will you end up selling all these properties before the fund closes?
Good question. So that we have this fund, as you saw here a moment ago, as a 10-year maximum fund length, which is 9 years from today. The reason we have the fund term long is so number one, we're not in the pressure to have to sell when the market's in a down cycle. So that's a big point on when we're going to exit. Is we certainly want to exit at a good time. So if that was a good time, turned out to be 5 years from now, turned out to be 7 years from now, turned out to be 8 years from now, we wanted that flexibility so we can maximize all of our investments. And then the likely exit, so there's two ways that this fund could wind down, two most likely ways. Number one is we sell off the properties to other investors. We sell them off one by one, or we maybe package up properties in a specific market. And we sell them off to other investors, at some point, as I said, in year 5, 7, 8, 9 from now. The other option, which is as we sit here today, it's not a guarantee, but as we sit here today, our desired option is that we will ultimately open another fund structure, maybe a REIT structure, may just be another private PPM type fund, but if it was a REIT, it'd be a private REIT as well, but another private fund structure that will roll up all the properties in this fund and then the other funds into where we'd be able to give investors the option to take liquidity and exit out and get their 17+% returns, or give investors the option to be able to stay in, continue to defer off tax, and continue to get great returns in a tax advantageous structure. So very likely we'll have an option at the end of this for you to be able to roll the money into and continue to defer out tax. But we'll either through an outside buyer or through sort of being our own buyer per se, we'll create a liquidity event at some point in the next 7 to 9 years.
Thank you.
Absolutely, great question. Another comment I realized I didn't topic I didn't cover that I just thought of that I think is critical. Every property we bought, every community we bought, which is all of these communities. So I think it's 16 communities that we've purchased so far. So it's certainly they're not all on here as I quickly do the math because I only see 13 communities on here, so a few are missing. But every community we've purchased to date, and every community we will purchase moving forward, I invest in or DLP Capital Partners, which DLP Capital Partners is myself, Bob, and Barry, my CFO and General Counsel. We invest into every single community. We put in at least 3% of the total equity into every deal. So each deal we're putting in $100 to $1 million. I think actually a couple of them have been more than that into every single one of these properties. The exact same structure as the equity fund, except we put our money in behind the equity fund, meaning we take the risk. So my money is invested in these properties right alongside of you. I am the largest investor personally in this portfolio of properties by far. So I think it's an important thing to mention that we're not here. We don't broker these deals. We're not syndicating deals. We're raising a fund that we're investing directly into these properties right alongside of you. So properties we buy are the same properties the fund's buying. Any other questions anybody has? All right, excellent. Well, hopefully when I exit this webinar here, I'll see some of these forms filled out. And but feel free, of course, to just reach out to myself or Larry or Bob if you have any questions. You want to dive into this deeper, face to face, in a call. And I know a number of the people on here are investors in this fund already. So appreciate everybody's time, and I'll respond back to a couple of these personal questions here later this evening. And thanks everybody. Have a great rest of your night.